วัสดีค่ะยินดีต้อนรับสู่การนำเสนอข้อมูลของบริษัท PSL Shipping จำกัดมหาชนนะคะในส่วนแรกคุณคาริด ฮาชิมกรรมการผู้จัดการบริษัทจะนำเสนอข้อมูลในเรื่องของภาพรวมของอุตสาหกรรมและต่อมาตามด้วยคุณกอตัมกุรานากรรมการทางด้านการเงินก็จะนำเสนอข้อมูลในเรื่องของตัวเลขผลการดำเนินงานตัวเลขทางการเงินนะคะและในส่วนสุดท้ายในส่วนของคำถามคำตอบค่ะเรามาเริ่มในส่วนแรกของกันเลยนะคะคุณคาริดcould you please start ค่ะ
Sawadee krap everybody. So as usual, we will do the presentation in two halves. In the first half, we will talk about the industry structure, and in the second half, Gautam will take you through all the financials of the company. So this is what's happened so far in the first half of the year this year compared to where we started off in 2016, and you can see that every high point connects very nicely in a straight line going upwards. So a trend has been established from 2016 onwards that the market is going to head upwards. If you just look at this year and compare it with, say, for example, 2016, which is the line right at the bottom, or 2019, which is the yellow ochre line here, or with 2020, you can see that 2021 is well above all those lines. And this is the BDI. Now, if you look at China's growth, the question is always this: can China sustain its growth? And if you look at the first half numbers, the answer is clearly yes. And I just read out the numbers for you. If you look at iron ore, it was up by 2.61% in the first half of this year compared to last year. If you look at coal, it was down by 20%, but remember in the first quarter, it was down by almost 30%. So it's catching up, and we think by the end of the year, this number will be either flat or slightly higher. In terms of steel production, China has done a marvelous job, 11.5% up. If you look at in terms of steel inventory, it's down by 10.5%. If you look at steel imports, it's flat, same as last year. And if you look at steel exports, it's up by 30%, but steel consumption has gone up by a massive 10%. So China has done very, very well for us in every aspect that you could think of. In terms of cargoes carried by our ships, what I want to emphasize from this slide is that we do not have any one single cargo or two cargoes which we are overly dependent on, and therefore we have no concentration risk in terms of types of cargoes that we carry. In terms of the dry bulk trade, I want to take away for this slide, which is done in billion ton miles. I just want you to take away two things. One is that demand for the years 2021 and 2022 is expected to grow quite strongly. Against that, the supply growth is quite weak compared to the growth in demand. And therefore, you will see both these years will have very high freight rates for us. If you look at the same trade just for minor bulks, then you see the same thing. In fact, it's even more pronounced. Demand growth in the minor bulks, which is what are the types of cargoes that we carry at pressure shipping, is expected to grow very sharply this year and next year. Against that, growth of tonnage is going to be fairly mild. So again, it will increase the rates for our size and type of ships. In terms of what's happened to the supply side, two things I want you to take away from this slide. The first thing is that there is a 45% fall in the scrapping of ships. We are down to 4.44 million deadweight tons in the first half of 2021 compared to 8.06 million deadweight tons in the first half of 2020. Yet, if you look at just the geared ships, that is the ships in our sector, you can see that scrapping has gone up by actually 11%. So our supply has reduced in the first half of this year, whilst overall, rather scrapping has increased by 11%, whilst overall scrapping has gone down by 45%. So in terms of balance ships to come up to the end of December 2023, if you look at that, you see that there is 50 million deadweight tons of ships on order, or roughly 5.41% of the world fleet as of the start of the second half of this year. If you just break that down into geared ships, it's 15.56 million deadweight tons, or 4.78% of the total supply. And if you look at the gearless ships or the bigger ships, 34.4 million deadweight tons, or 5.75% of the existing supply. Anyway, it doesn't matter whether you look at the overall number of 5.41 or just look at the geared sector or look at the gearless sector. All these are 25-year lows. This is from the time that the order book to fleet ratio has been calculated by Clarkson's going back to 1996. If you look at the change in the fleet as of the first half of this year, what do you see? You see we've added 17.25 million deadweight tons of ships, which is 13.3 million deadweight tons in the gearless sector or the larger ships, and just 4 million deadweight tons in our sector, in the geared sector. So we are not adding many more ships, we're scrapping more ships compared to the overall fleet. If you look at the total fleet, it's at 900, it's expected to be at 900, and it's right now at 924 million deadweight tons at the middle of the year. Order book is at 50 million deadweight tons, so roughly 5.41%. But the existing 20-year-olds, which is this line, the red line that you see here, is at 6.73%. And the same 6.73%, if you were to take this 20-year-old age up to 2023, it would be 12.2%. So whichever way you look at it, the order book looks more like replacement for the older ships. If you look at the handy-size fleet, you see the same thing like this, that 111 million deadweight tons is the overall supply at the middle of this year. Total order book is 3 million deadweight tons, or 2.71%. The existing 20-year-olds, 13.5%, and like for like in 2023, almost 18%. So here you will find a shrinkage of the fleet. So the cargoes that were carried by this fleet after it shrinks will move to the Supramax, Ultramax sector. Here, what do you see? 215 million deadweight tons of ships, 12.5 million deadweight tons on order, and the order book to fleet ratio at 5.8%. Overage ships or over 20 years as of today, 9%, and like for like 14.5%. So again, you see that this fleet is not really going to grow. It might marginally grow or marginally reduce. And the cargoes which are coming from here and also the increase in cargoes expected are going to make rates for both these sectors pretty strong. So what is our strategy? Our strategy remains the same. We will try to make sure that we fix our ships on long-term charters. Currently, long-term charters are at a significant discount to the current spot. For example, if you look at Ultramax ships, we have seen a few fixtures in the market reported by other publicly listed companies where they have fixed 3 ships on 2-year charters at $24,000 a day and 1 ship on 1-year charter at $27,000 a day. Versus that, the spot rate is around $32,000, $33,000 a day. So quite a big discount for the 2-year charter and still a reasonably large discount for the 1-year charter. So we think that maybe if we wait till the end of this year or early next year, we will be able to get a reasonably small discount to get longer term charters. And so far we have not seen any charters in excess of 2 years. What we are looking for to lock in is maybe 3 to 7-year charters. And for that, there is no market at the moment. This is our forward book. So in this slide, what do you see? In the candle bars, you see the number of days which have already been pre-booked at the start of each of the years as of today. And if you look at that as a percentage of the overall fleet days, you can see that it's on this line. And then if you see what is the rate at which it has been fixed, then the TC rate fixed has been like this, 14,219 for this year, going up to 15,316, because some of the older, longer term charters will be cancelled or rather will expire during 2022. And then only the really long term charters will be there and they will be at this average rate. Now, if you take this rate and multiply it by the number in the candlestick, then you will come to the contract value, which is shown on the top. Coming to, is this time different? It certainly looks like that, because if you look at the rates experienced in Q1 or the rates experienced in Q2 or the rates experienced in the month of or the change in rates between Q2 and Q1, you can see how strongly they have gone up. And if you compare that with the best year in the last 11 years, which is 2009, you can see other than Capes, which is slightly lower, all other sectors are higher, starting out in Q1 almost the same, and in Q2 it's certainly higher. Now, the 3 main things to take away from this slide is that the overage ships are at 6.73% of the existing fleet today. The forward order book today is 5.41%. And that scrapping overall has slowed down by 45%, but in our sector has gone up by 11%. Coming to the changes year over year between quarter 1, quarter 2, and July 21 versus quarter 1, quarter 2 of 2020 and July 2020, what do we see? We see quarter 1 is up by these percentage terms in each of the 4 sectors of the dry bulk market. Quarter 2 is up by another massive amount. And if you look at quarter 3, other than the Capes, all others are up also significantly higher. Now, maybe the comparison with 2020 is not very good because of COVID impacting 2020. So let's look at the 10-year average. So if you take the last 10-year average, you see these are the rates in quarter 1. And if you compare that with our quarter 1 2021 or the index ships quarter 1 2021, you see that 2021 is higher than the last 10-year average by almost double or more than 100% in each of the cases. If you look at quarter 2, this is the average of the 10 years, and this is what we got. And here you can see it's almost 3 times as high in all cases. So it seems that the market is going from strength to strength. The other thing to notice is that if you were to look, say, at quarter 1, quarter 2, quarter 3, quarter 4 of each year of the average 10 years, then what do you see? You see that every quarter is higher than the previous quarter. So quarter 2 is higher than quarter 1, quarter 3 is higher than quarter 2, and quarter 4 is higher than quarter 3. So you can see this in the Capes, in the Panamax, in the Supramax, and the Handysize. And then if you compare quarter 1 versus quarter 2 of this year, you can see how strongly it has grown this year compared to the last 10-year average. So for Capes, it's grown by 82% between quarter 2 and quarter 1, as against an average of 12% growth in the last 10 years. Similarly, if you look at Panamaxes, it's 41% growth compared to a 2% growth in the past 10 years. If you look at Supramaxes, 54% growth compared to a 5% growth rate. And if you look at Handysizes, a 36% growth compared to a 3% growth rate. If you look at July, then for the Capes, it was not a very good month, but it has increased significantly thereafter. But just looking at July, it looks like it is almost the same as quarter 2. Quarter 1 and quarter 2 are roughly similar, marginally down. But if you look at any of the other sectors, then you can see that in Panamaxes, it's up by 31%, Supras is up by 24%, and Handys are up by 34%. So it shows that the market continues to grow from strength to strength. And as I said, August looks even stronger than July. Now, generally speaking, when you have such a high market, you would also find a lot of new ships being ordered. So we try to analyze how many ships were ordered in first half 2021 in terms of deadweight tons and compare it with the last 2 years, 2020 and 2019. So if you look at that and look at the BDI and compare the BDI first, you see the BDI in 2021 it was higher by 230% compared to the BDI of 2020, and it's 152% higher than the BDI of 2019. Now, in terms of overall, total ships ordered in the first half of this year compared to first half of 2020 was higher by 37.1%. And if you compare it with 2019, it was down by 7%. Now, if you look at the same thing just for our sector, just the geared sector, what do you see? You actually see that ship ordering was down by 45% compared to 2020 and was down by 35% compared to 2019. So you can see clearly that the geared ships have not gone up anywhere near what you see the gearless ships have gone up. Here you can see the gearless ships compared to 2020, gearless ships went up by 110% and by 4% compared to 2019. Now, what are the reasons why new build ship orders has been very restrained in the first half 2020? And that was mainly because of these 3 reasons. One is that the dry bulk owners have had a 12-year drought in rates and so have no money to invest. Secondly, containers, tankers, and gas ships have booked all available slots. So dry bulk has been crowded out of the shipyards and will get ships only in 2024 or 2025 at the earliest. And third, and the most important reason, current legislation and expected regulations will expedite the death of the internal combustion engine burning fuel oil ships before they reach the end of their economical life. So you will find that people are scared to order these type of ships today and would rather wait to see what type of zero emitting ships will come in the future. And we're expecting a lot of ammonia engine ships to be delivered between 2024 and 2025. And once they start performing, people will start ordering more of those ships. So this is the main three reasons why ordering has been very restrained. If you come to market segmentation, we have shown you here the average deadweight of the index ship. And we've also shown you what is our average deadweights. Then we've shown you what is the speed consumption of the index ship. And then we've shown you what is the speed consumption for our ships. Now, this is what the index ships earned in Q2. And this is what we earned in Q2. So we were down from the index ships by 30% and 21%. But there are three reasons why we are lower than them. So first of all, our ships are different from the index ships. Therefore, on an apple-to-apple basis, our handy ships are 25% below the index ships and Supras are 10% below the index ships. Secondly, 5 handy ships out of the fleet of 19 are on long-term charters at a fixed price of 14,537. And 1 Supra is out of our fleet of 17 is at 13,421. And if you compare that with the average TC rate for the index ships in Q2, it is well below 22,507, which is for handy ships, and 25,538, which is for Supra ships. Now, if you see the way the market has gone up virtually in a straight line, if you have fixed all your ships on day one of Q2, the index levels were at this level, and supposing you got by magic, even though our ships are not as good, let's say we didn't have anything on a long-term charter, if we just had to look at the index ships and you fixed everything on the first day of Q1, you would still be 9% below the average price of Q1 and 21% below for the Supras as compared to the average of Q2. So this is another issue that we have to look at. So if we were to apply these three underperformance issues, then what would you see? For example, if you look at the Baltic Handy Size Index, if you reduce it by a quarter, then it will come down to this level. Similarly, for the Supramax Index, if you reduce it by 10%, it will come down to this level. If you then look at the difference between the first day of the fixture and the average of the quarter, then you have to further reduce the benchmark by 9% for handies and 21% for Supras. And then if you were to look at what the long-term ships which are there in the fleet already with us, how would they impact us? Then you can see there are 5 handy ships out of 19 or 26.3% of our fleet, which is fixed on long-term charters at 14,537, which is 35% below the index level. So if you multiply this minus 35 by 26.3, you will come to minus 9.32%. And similarly for the Supras, you come to minus 2.79%. Now, if we applied all those three factors, so factor of difference in rates because of this 25% of the discount in the handies, 10% discount on the Supras, the first day effect compared to the average of the quarter, then you discount 9% on the handies and 21% on the Supras. And then for the long-term charters, you have to discount further 9.3% for handies and 2.8% for the Supras. After all those discounts are added in, then this is the number. And therefore, if you add this to our rates that we have earned, you'll see we actually outperform the index by 13.4% in the case of handies and 12.5% against the Supras. So that is our true performance versus the benchmark ships. So what are the key takeaways from the industry that you should look at? The key takeaways, of course, COVID-19 had a major impact on global economic activity in 2020. China was the only major economy that had positive growth rate of 2.3%. All others had a large drop in GDP rates. Chinese governments also issued what are known as COVID bonds or special bonds, and they used that to fund the 667 billion steel-intensive fiscal stimulus plan. Now, in 2008, after the GFC, China came out with a $578 billion steel-intensive plan in 2009. This is roughly 16% below what they've done for this particular crisis. And that $578 billion took the BDI from a low point of 666 points on 6 December 2008 to a high of 4661 points in 2009. And currently we are already at the 3,600 level. So for us to go up another 1,000 points, I think we could do that before the end of the third quarter. That's the way the market is going up right now. So what do we notice? We notice that there's a material improvement in dry bulk demand and rates since June 2020, and this we think will last at least till 2022 or maybe even 2023, 2024. BDI has already reacted positively to all the stimulus, fiscal, monetary, and steel intensive, and this total fiscal and monetary incentives and the steel intensive support is worth at least $20 trillion. So we think, therefore, this will last beyond 2022 also. Time charter earnings in first half 2021 are far stronger than the average for the last 10-year first halves. Now, despite all the positive news, orders, new ships ordered in first half 21 are up on first half 20 by 37.1% due to low base effect from COVID-19, but down on first half 19 by 7%. And if you were to look at just the geared ships, that is our sector, then it is down by 45% first half 21 compared to first half 20 and 35% compared to first half 19. So we are even smaller. Our growth has even shrunk further in the geared sector. Coming to COVID's impact on shipping, if you look at container shipping for 2020, at the beginning of the year, they predicted a $23 billion loss for the container business. They ended up making a $15 billion profit. Actual trade in TEU terms was just down by 1.85% in 2020. Drewry is forecasting that the annual profit for this year will be about $100 billion. So a massive, the highest profit that they've ever made as a collective for the container business. Maersk has increased its EBITDA forecast for this year to almost $20 billion compared to their last forecast of $15 billion. And Hapag-Lloyd again has also increased their EBITDA forecast to $11 billion. Now, the reason why the container business in 2020 did so well is that they were able to reduce supply by almost 13% at the peak of the COVID crisis around the middle of last year. In terms of dry bulk shipping, the first half 2020 had a big impact from COVID-19. China stabilized in the second half of 2020, and so freight markets improved. And the rest of the world also opened up in the second half of 2020. So from there onwards, we've had a very sharp V-shaped recovery all the way through to first half 2021. And we think that this recovery will continue. In terms of supply side forecast, if you see what's happened in the first quarter, we've actually gone from 907 million deadweight tons to 924.24 million deadweight tons. And if you apply the same metrics here to the balance which is there to come in the second half of this year, then you will see that we'll end up with 933.8 million deadweight tons, or roughly 26.82 million tons of additional growth in ships, or 3% growth rate. This is the fiscal and monetary stimulus put up by various economies. Remember, the American economy is also looking at now somewhere between $1 trillion and $3.5 trillion worth of infrastructure spend. Now, that has not been taken into account in this slide here because it's not yet been passed by the Congress. So they're waiting for that to be done, and hopefully that should be completed by the end of next month. So that will again add a significant boost to this number. Right now, this number is anyways at 24% of world GDP growth rates, world GDP growth in 2020 of $84 trillion. Investor relations activities, as you can see, we've had at least 50 meetings in the first half of this year. And if you compare that with the previous years, you can see that we are going to beat all previous year records. And the reason for that is not that we have suddenly upped activity level. It is just that shipping has become very important to all investors because the industry is doing so very well. Coming to financials, Gautam?
Yes, thank you, Khalid. So the highlights for the second quarter of this year were that we repaid our bond PSL 206A in full on 23rd of April. We signed a 38.35 million loan agreement with Credit Agricole on 21st of June, and we used the proceeds of that to repay PSL 211A on 22nd of July. We also signed an $85 million loan with IFC, Exim Bank, and TTB on 29th of June, and the proceeds of that will be used to repay existing vessel indebtedness, as well as to make a final redemption payment for PSL 211A within this third quarter. So here's the financial profile. So our cash and cash equivalents position remains very healthy. It was at the end of the second quarter, it was at 39.6 million, somewhat similar to the figure it was at the end of 2020. It was 36.6 then. Total assets came down to 680.8 million, down from 712. This is as a result of depreciation of ships that we hold. Our net debt was down to 229 million from 281 million as we aggressively paid down our debt. Our equity position moved up to 377 million from 337 million due to the profits that we had in the first half of the year. Our net debt to equity ratio is down to a much more healthy 0.61 compared to a 0.83 at the end of last year. The number of ships that we have in our fleet remains the same at 36. Our Ebitda in the first half of the year was a very healthy 55.4 million compared to 36 million all of last year. And the only year where it was higher on a full year basis is actually 2018 when it was 68 million. Our debt to Ebitda ratio came in at 3.4, far below the 8.4 figure at the end of last year. This was because of higher daily earnings, which came in for the first half of the year at 15,015 compared to 8,332 for all of last year. This is in fact the highest it's been in almost a decade. The daily OPEX is slightly higher than last year as our crew change expenses remained elevated. For the first half of the year, we had a net profit of 38.5 million compared to a full year loss of 40.8 million last year. Our total revenues for the first half of the year came in at 107 million, actually quite similar to the 107.5 million figure for the full year in 2016. Here's a breakdown of our operating expenses for the first half of 2021 and full year 2020. As I mentioned, so our crew costs remained elevated. This is because our crew have to undergo quarantine at various ports that they're joining at, and so therefore the manning expenses you see is elevated. It's at 248. Then there's also a slightly higher figure on insurance and slightly higher figure on stores and spares. And this is partly because we send our spares around the world to various ships around the world, and freight costs actually are a little bit higher right now, and that therefore the stores and spares expenses are a bit higher as a result of that as well. So our target is 4750, but that is really a non-COVID period target. 4988 reflects the elevated costs of operating ships during COVID. So here's an OPEX comparison, operating expense comparison with the industry. So for 2019, which is the last year when where figures are published, you will see that we are $700 per day. Our operating expenses are $700 per day, below the industry average. Now, every $100 in savings translates to $1 million on the bottom line for full year earnings. So this is quite a significant figure. Here's the financial highlights showing also our quarterly figures. So for the second quarter of this year, our total revenues came in at a very, very strong 62.58 million, up from also relatively strong 44.5 million in the quarter one of 2021, and much higher than the 20.86 figure in quarter two 2020, which is frankly the worst time because of COVID. The net profit for the quarter was 26.23, far above the 12.32 figure reported in quarter one. Our our Ebitda for the quarter for the second quarter came in at 35.28 million, much above the 20.11 million figure in quarter one. And this was because of average TC income per ship per day being very high. It was at 17,841 compared to 12,157 in the first quarter and compared to, in fact, 6,099 in the second quarter of last year. As I mentioned, so operating costs continue to be elevated. The earnings per share that we had in the second quarter were 0.53 compared to 0.24 in the first quarter of 2021. And our net profit margin was 41.91 compared to 27.67 in the first quarter. Some financial highlights. Liquidity, including the undrawn commitments that we have from IFC and Syndicate and also Credit Agricole, that stood at 162.95 million at the end of the second quarter. So a very healthy level. Our total long-term loans came to 188.7 million, down from 207 million as we paid down our debt. Debentures, as I mentioned, so we've been continuing to pay down our relatively expensive debentures. So that's down from 126 million to 80 million at the end of the second quarter. Total shareholders' equity, as I mentioned, it's gone up to 377 million. The book value per share is also up because of the profits. That's standing now at 7.75 compared to 6.5. Return on equity was 18.79% compared to minus 3.67% for last year. Yeah. This shows the top line shows the average age of our fleet from 1995 to first half of 2021. You will see that from 1995 to around 2011, we had a relatively old fleet and also a much smaller fleet. And ever since then, we embarked on a program to order new ships, and the average age of our fleet came down. It is currently 9.8. The line below that shows you the average size and deadweight of our ships. So from 1995 until about 2011, the average size of our ship was about 20 to 25,000 deadweight, and then we stepped up quite a bit. We bought a number of large Ultramax, Supramax vessels, and so now the average size of our ship is almost double what it was in a decade ago, so that it's about 44,000 deadweight. The line below that shows the average time charter earnings for our fleet. You'll see that in 1995, the market was quite good. It doesn't appear so compared to today's numbers, but in 1995, 7,306 was quite a healthy number. Then you had the Asian financial crisis, earnings went down. And then you had China joining the WTO in 2001. And there was the infrastructure boom. They were buying a lot of infrastructure from around the world, and dry bulk shipping benefited significantly. And you saw a great increase in rates. And then unfortunately what happened is a number of ships were ordered. There was the supply side of the equation increased too much. And as ships started to get delivered, the rate started to decline. And we saw the bottom in 2015-16. And ever since then, we've seen a gradual uptrend as the supply side pressures have now gone. The line below that shows the operating expenses, which have been quite stable over the years. This shows our debt and debt to equity ratio over time. You'll see that at some points of time in our history, we have actually come down to zero debt when we were making very significant profits. And then we embarked on a program to order new ships, and debt went up, but that is moving in the right direction. It's moving down now, and it's at a much healthier level. Again, so this is our debt to Ebitda ratio. So it's at an elevated level when we took delivery of a number of ships, and unfortunately that was also when the market was a bit weak, but now the market is very much in our favor, and so that ratio is also very healthy. This shows the cash operating profit and operating profit. You'll see that there's very few times in our history where the cash operating profit has been less than zero. So it's, yeah. Again, showing the net profit. So the net profit that we've had in the first half of the year sort of resembles the profitability that we had during the boom years in 2003 to 2009. So, this shows the dividends that we have paid over time. Now we've announced earlier this week payment of a 50 satang dividend. We've resumed paying dividends for the first time since 2014. Our policy is to pay not less than 25% of net profit as dividend. But for this first half, it is greater than 25%. This shows our ESG footprint. So the industry is now is forced to be much more environmentally conscious, and we have been taking action to ensure that our footprint is reduced. So our average fleet emissions on a CO2 per ton mile, nautical mile, has reduced from 12.884 in 2014 to 9.941 in 2020. We've retrofitted fuel-saving devices on our ships, and that helps us save fuel by about 3 to 5%. We have a formal, which is quite unusual for a dry bulk company, we have a formal environmental policy statement since 2009, and then it was upgraded in 2015. We're also part of a global coalition called the Getting to Zero Coalition. We're a founding member. It's an alliance of 140 companies within the maritime sector to explore commercially viable zero carbon emitting vessels. We have an in-house training institute and a full ship simulator. We've recently, on 12th of August, we announced a plan to distribute 42,000 free meals over 60 days to COVID-affected communities in Bangkok. We're a signatory to the Neptune Declaration covering seafarer well-being and crew change. We've deviated ships at huge commercial cost to us to sign up our seafarers. Now, it's very, very difficult to effect crew changes, and we have to incur additional costs, and you're seeing part of those additional costs seep into the higher operating expenses, and all of these costs are borne by us. It's not borne by customers. We provide scholarships to 42 maritime students each year. Many of these students join us. They have careers with us. We built, in the past, we built an 80-bed dormitory at a cost of $1 million at the Nakhon Si Thammarat Technical Institute. As far as governance is concerned, so we were classified as a company with excellent corporate governance for 11 consecutive years, from 2010 to 2020 by the IOD. We were pleased to be the only shipping company in the entire ASEAN region to receive what's called the Asset Class Award in recognition of our having attained a score of above 97.5 in the 2019 ASEAN Corporate Governance Scorecard. And we've been certified as a member of Thailand's Private Sector Collective Action Coalition Against Corruption since August 2019. This slide shows the return that our shareholders have enjoyed since we went public in 1993. So if you were an investor in our IPO in 1993, you would have made a 23 times return on your initial investment. So a very, very healthy investment. Healthy return. So for some final food for thought. So demand is growing faster than supply growth, and this should be good for the next couple of years. Minor bulks, cargoes that PSL carries, are growing faster than other cargoes, and certainly faster than supply growth in the geared sector. So PSL is a Thai corporate, but we have zero business out of Thailand. COVID-19 cases spiking in Thailand, and the weaker Thai baht does not affect our business in a negative way. The weaker Thai baht, if anything, makes our EPS in Thai baht stronger, as all our income is in US dollars. So if you need a Thai stock that is unconnected with the Thai economy, then PSL is such a stock. Part of our Bangkok expenses are in Thai baht, and they would reduce with the weaker Thai baht. Our bond PSL 211A will be refinanced with the drawdown of the $85 million loan that we're getting from IFC, Exim, and TTB. And as the Thai baht weakens, our liability on this bond also keeps getting smaller when measured in USD terms. Our overall debt continues to shrink, and surplus cash generated from our business continues to grow. This should, of course, be very, very good news for our shareholders. With that, we're open for questions. I see the first question, actually, why PSL chose to pay dividend instead of pay back the remaining bond with high interest rates. So we've signed an $85 million loan with IFC, and we've publicly announced that the proceeds of that loan will be used to redeem PSL 211A, the balance amount, the remaining amount. There will be nothing else remaining.
Second question is halfway through Q3, how much is the average freight in this quarter? This is again a forward-looking statement. We are not able to answer this. Third question, observing that long-term fixed TCs have notched up from those shown in Q1. What are the reasons? Do we expect to see further increases in future? As I said, right now the long-term charters fixed by others, not by us, is at a significant discount to the spot, and we are not happy with the discount rates. And so we would be happier to let the market continue to ride like this and then only fix the ships at a later stage on longer term contracts. Will the company consider buying more ships? No, we have no desire to buy any more ships. We think that we should utilize the ships that we currently have and which we have bought and paid for in the past and use them to A, reduce our debt, and B, reward the shareholders for their patience. The next question is the current high rate justifying fixing long-term contracts? Yes, the current high rates would justify fixing long-term contracts, but the clients are not prepared to pay us the current spot rates for longer-term business, and that is understandable. But we think that that will change by the end of this year, early next year, when we will do the longer-term contracts. What is the reason behind the highest rate of $45,000? At what point in Q2 that the highest rate occurred? How will this high figure affect the rate in Q3? Okay, so we can't answer all these questions for you because we don't give this information out on a more detailed basis. So we only need to give you what we have shown to everyone else. But suffice it to say the $45,000 fixture was done during Q2. Normally, next question, normally the company rate is same as industrial rate or lower or higher. So again, as I have explained the breakdown, why we are not able to compare with the industry today. And I've shown you the 3 areas which you need to think about before you compare an apple to an orange. So we need to distinguish between our ships and the index ships. That's 1. 2, we need to distinguish between the rates on the first of the quarter and the average rate for the quarter. And 3, we've got to remember how many ships are on long-term charters. Today, those long-term charters look very cheap compared to the market. But remember, those are the long-term charters that kept us alive during the bad times of the market. Next question, why did the company rate in Q2 was lower than industrial average? How is the company plan to resolve this issue? We've explained this to you in great detail during the presentation. Number 9, in your point of view, will demand for Q3 be better than Q2 in terms of big and small dry bulk ships? Again, if you look at the presentation, the idea of giving you all those numbers is for you to understand that every quarter in the last 10 years has been higher than the quarter preceding it. So, and we've shown you already in Q2, the month of July has been stronger than the average of the last 10 years July. And similarly, the Q2 number that we have already seen in the various sectors for average for Q2. And similarly, we can say clearly that August so far has been stronger than what we have seen July up to date. And you can see that from the index ships numbers. Next question is, please explain the table in slide 4 about the company rate compared to industrial rate. Again, I'm not fully understand and confused with that. Why don't you please call us up, separately for this question? We think we've explained it well enough, but we can do that a little later. The next question, last quarter opportunity day, you mentioned that you believe that this time is going to be a super cycle. Do you strongly believe so? Yes, we can say that there is going to be a super cycle. The question is that when you say super cycle, what do you mean by it? Does it mean that a super cycle compared to the last 10 years? Yes. If you compare to the last 10-year averages, we are certainly in a super cycle. If you want to compare it with 2007 and 8, no, we are not in a super cycle. Next question, company's loan in Q2 to be utilized for the redemption, whether it helps reduce financial costs and by how much, Gautam?
Yeah, so it will definitely help reduce financial costs, but the how much is not something we really disclose granular detail of.
Next question is, management mentioned in MD&A that there are 3 reasons under why the new order book is surprisingly low. Among the 3 reasons, which one has the most impact? The last one, the last reason, that is the new regulation which is coming in, which will make such brand new ships burning fuel oil redundant in a shorter time than their economic lives. The next question, as the companies predicts if the supplies as expected in 2022 will be a good year as well as 2021. Whether would 2022 be better than 2021? In fact, I was just reading an article in one of the shipping newspapers where other industry players, I'm not talking about PSL, but other industry players were making a statement saying that they expect 2022 to be at least equal to 2021, if not better. So they expect it to be stronger. What is EEXI? How will it affect dry bulk sector? Whether PSL needs to do something to comply with EEXI? Okay. EEXI is the energy efficiency existing ship index. How will it affect dry bulk sector? It will reduce the supply of ships in the dry bulk sector. How will it do that? It will do that in two ways. One way is that the very, very old ships, which are badly impacted by EEXI, will be sent for recycling. So it will permanently remove them. And then roughly anywhere between 50 and 75% of the existing fleet will have to slow down. And that will reduce effective supply. So starting in 2023, you will find supply starting to shrink, even if nothing else happens because of the EEXI. As far as we are concerned, yes, we will also have to do it. Again, the rules of this have not yet been laid out clearly, but let's say that somewhere between around 35 to 55% of our fleet may need to get some sort of speed reduction done. So we'll have to see how the rules come out, and then we'll have to decide the total cost for doing all of this based on currently available information, because we don't have all the facts as yet, should be less than $1 million for us. So it's nothing really in terms of cost. The next question is, how will carbon intensity indicator affect supply of dry bulk sector and PSL? Now, what this will do is that people who have a high, or ships that have a high carbon intensity indicator, will be forced by law to reduce their carbon intensity. And one method of doing that is simply to slow down the ship. So EEXI will also slow down the ships, so will carbon intensity indicator slow down ships. Again, this will reduce the effective supply. Why administrative expenses double from last quarter? Yes.
Excuse me, the time is out. Maybe the last question, Khun Khalid.
Yeah. Okay. So this question, Gautam, can you just please quickly explain it?
Yeah, sure. So administrative expenses are higher because of higher personal expenses that we incurred in the second quarter. Some of those expenses were one-off. Some of those expenses will be sticky.
Yeah. So there's one last question. What are the signs that the freight rate has reached its peak and is about to go down? So far, there are no signs of this at all. So I'm afraid now we've run out of time. So we must thank you so much for spending time with us. สวัสดีครับ
สวัสดีค่ะในส่วนของคำถามคำตอบก็คือจะไปติดตามได้ในเว็บไซต์ของบริษัทนะคะค่ะ